One ruling, written in 1967. 0 tribal casinos existed anywhere on Earth. That ruling now governs every per capita casino check distributed to tribal members, and most people have never heard of it. The Shakopee Mdewakanton Sioux Community in Minnesota runs Mystic Lake Casino. Each enrolled member reportedly receives hundreds of thousands, sometimes over $1 million annually. The IRS is collecting on every single dollar, under a rule older than the casino industry itself. Most people assume tribal casinos exist in some kind of tax-free sovereign bubble. The casino itself pays no federal corporate income tax, that part is true. But the moment that revenue moves from tribal treasury into an individual member's bank account, it transforms into fully taxable ordinary income, subject to federal rates up to 37%. Same money, same sovereign land, two completely different tax universes separated by one accounting entry. The document that made this possible is IRS Revenue Ruling 67-284. It is 11 paragraphs long. Most policy debates about tribal sovereignty have never engaged with it. This video is going to read it line by line and show you what it actually says. Because what it says changes the entire public conversation about what tribal sovereignty actually protects. And more importantly, what it has never protected and was never designed to protect. Let us start at the beginning, not with a casino, with a piece of paper. The year is 1967. The place, the Internal Revenue Service, Washington, D.C. Tribal gaming does not exist. The Indian Gaming Regulatory Act will not be written for 21 more years. That gap, 21 years, matters more than almost anything else in this story. Writing Revenue Ruling 67-284 in 1967 is like writing Internet tax law in 1982. The technology, the industry, the money, none of it exists yet when the rules are written. But the IRS writes the rule anyway, quietly, without congressional debate, published in the Cumulative Bulletin. The Cumulative Bulletin is the IRS's internal record of official tax guidance. Most Americans have never heard of it. Most policy discussions about tribal sovereignty never cite it. Revenue Ruling 67-284 appears at page 55 of the 1967 second volume Cumulative Bulletin. Its official citation is 1967-2 CB 55. It concerns a narrow question: are per capita payments from tribal trust funds taxable to members? The trust funds in question, in 1967, were modest: land claims, settlements, small annuity distributions. The IRS answer in 1967 is 4 words that will echo for decades: gross income. Section 61. Section 61 of the Internal Revenue Code is the broadest possible tax net Congress ever cast. It defines gross income as, quote, all income from whatever source derived. That phrase, whatever source derived, is doing enormous legal work in the context of tribal sovereignty. Because the argument tribal advocates would later make is that a sovereign source should be different. That money flowing from a sovereign tribal government to its citizens should not be subject to federal taxation. The IRS in 1967 rejected that logic before a single casino chip had been counted. The ruling states that the per capita payment is gross income regardless of the tribal governmental source. The institution is sovereign, the payment is not. This distinction between sovereign institution and taxable individual is the hinge on which everything else turns. Think of it this way: a municipal government in Ohio pays no federal income tax, but every city employee in Columbus who receives a paycheck files a federal return on that salary. The institution's sovereignty does not transfer to the individual transaction. Tribal gaming works exactly like a nonprofit's relationship to its employees. The casino is the nonprofit. The per capita distribution is the paycheck. Sovereignty protects the building, not the envelope. This is not an analogy invented for convenience. It is the actual legal structure Revenue Ruling 67-284 created. And in 1967, nobody in Indian country was particularly alarmed by it. Because the amounts were small. Because no casino existed. Because the ruling seemed like fine print. Fine print has a way of becoming load-bearing wall when the building gets much larger. Now, let us look at the specific language of the ruling more carefully. The ruling identifies the situation. A federally recognized tribe distributes money to enrolled members from a trust fund. The trust fund holds money paid by the United States government treaty obligations, land settlements, claims awards. The ruling asks, does the payment lose its taxable character because it passes through a tribal sovereign? The answer is no. The ruling explains why in language that is precise and, once understood, absolute. The key principle, the tax exemption for tribal governmental entities, applies to the tribe acting as a government. When the tribe spends money on roads, schools, hospitals, administration, that is the sovereign acting governmentally. But when the tribe distributes money directly to individual members as personal income, that is a different transaction. The individual tribal member is simultaneously a citizen of a sovereign nation and a United States citizen. That dual citizenship is not a loophole. It is the legal architecture deliberately built by Congress over a century. And as a United States citizen, the individual member is subject to the Internal Revenue Code. Revenue Ruling 67-284 is the IRS stating that second citizenship clearly and on the record. The ruling does not express hostility to tribal sovereignty. It simply draws its boundary with precision. The boundary runs through the individual's mailbox. For 21 years after the ruling, this boundary is theoretical for most tribes. Trust fund distributions exist but remain modest. The ruling applies to small numbers of people, small amounts. Then, on October 17, 1988, President Reagan signs the Indian Gaming Regulatory Act. IGRA, as it is universally known, creates the legal framework for tribal gaming operations. Class II and Class III gaming. Tribal State Compacts, the National Indian Gaming Commission. IGRA transforms the economic landscape of Indian country in ways its drafters likely did not fully anticipate. But here's the critical detail almost nobody in the public debate has focused on. IGRA is completely silent on the tax treatment of per capita distributions to tribal members. The statute does not say distributions are tax-free. It does not say they are taxable. It says nothing. It contains no language addressing the IRS question at all. That silence is not neutral. Silence in the presence of an existing IRS ruling means the ruling controls. Revenue Ruling 67-284 was sitting there in the cumulative bulletin, untouched, operative. Congress passed IGRA, tribal casinos opened, revenue grew, and the 1967 ruling applied to every dollar. This is not a conspiracy or an oversight by hostile bureaucrats. It is how tax law operates. Existing IRS authority governs new situations unless Congress expressly overrides it. Congress did not expressly override Revenue Ruling 67-284 in IGRA. That silence would cost individual tribal members collectively billions of dollars over the decades that followed. But what came next is what most accounts of tribal gaming economics have never taught. IGRA, Section 2710, Subsection B, Paragraph 3, contains a requirement most people skip past entirely. Any tribe that wants to make per capita distributions from gaming revenue must submit a distribution plan. That plan goes to the Secretary of the Interior for approval before a single check can be written. The Bureau of Indian Affairs reviews the plan. The Secretary approves or rejects it. This approval process creates a federal paper trail, documented, official, permanent, for every per capita distribution program. And that paper trail is not just sitting in a filing cabinet at Interior. The BIA and the IRS operate in coordinated oversight of money flowing to individual tribal members. The same federal government that approves the distribution plan is the federal government waiting to tax it. One agency says yes to the payment. Another agency sends the tax bill. Two arms, one federal body. For tribal members receiving large per capita payments, the practical implications of this structure are significant. The tribe distributes a check. The tribe simultaneously issues a Form 1099 MISC or equivalent tax document. The member files a Form 1040, the exact same form used by any American wage earner. The income is classified as ordinary income, not capital gains, not dividends, not some special tribal category. Ordinary income, the highest rate, currently 37% at the federal level for large distributions. A Shakopee Mdewakanton Sioux Community member receiving $1 million in per capita distributions sends $370,000 or more directly to the Internal Revenue Service, $370,000 from a payment generated on sovereign tribal land under a 1967 ruling. The Shakopee Mdewakanton Sioux Community has approximately 1,887 enrolled members by published reports. That is a community smaller than most American high schools. Mystic Lake Casino, operated by the Shakopee on federal trust land in Prior Lake, Minnesota, generates revenue on a scale that dwarfs most regional businesses. The per capita distributions from that revenue are among the largest of any tribal nation in the United States. Each enrolled member reportedly receives distributions that individually exceed most Americans' annual salaries, sometimes by a factor of 10 or 20. Every dollar of it is ordinary income. Every member files a federal return. Revenue Ruling 67-284 applies to all of it. The casino pays no federal corporate income tax. Its members pay federal individual income tax at full rates. Same land, same revenue stream. One tax reality for the institution, a completely different one for the people. This is not unique to the Shakopee. It is the operating structure for every tribe that distributes gaming revenue per capita. The Eastern Band of Cherokee Indians in North Carolina runs Harrah's Cherokee Casino, one of the largest in the Southeast. The Eastern Band has approximately 16,000 enrolled members, a much larger community than the Shakopee. Beginning in 1993, the Eastern Band began distributing per capita payments to enrolled members from casino revenues. Those payments are reported to the IRS as taxable income. Members file federal returns. Revenue Ruling 67-284 applies. The Eastern Band has used per capita distributions explicitly as a poverty reduction tool, a deliberate governance choice. Child poverty rates on the Kuala boundary, the Eastern Band's land base, fell measurably after distributions began. Researchers studying the Eastern Band found long-term improvements in educational attainment and mental health outcomes for members who received distributions in childhood. The per capita mechanism worked as policy, as poverty reduction, as investment in human capital, and the IRS taxed every payment under the 1967 ruling without exception. The Eastern Band's governance philosophy about distributions is not the same as the Shakopee's. They are different nations. Some nations invest gaming revenue collectively, infrastructure, healthcare systems, language preservation, housing, rather than distributing per capita. Those collective investments by the tribal government are not subject to federal income tax under sovereign immunity principles. The roads built with casino revenue are not taxable. The hospitals funded by gaming are not taxable. Only the individual, check the direct payment to a member's personal account, triggers Revenue Ruling 67-284. This creates a genuine governance dilemma for tribal leaders that goes largely unacknowledged in public policy debates. If a tribe invests collectively, it preserves maximum economic benefit, no federal tax leakage on institutional spending. If a tribe distributes per capita, individual members gain immediate economic power but lose a third or more to federal taxes. The 1967 ruling does not tell tribes how to govern. It does, however, price the per capita option differently. And here is where the evidence of that pricing becomes impossible to ignore. In 2014, Congress passed the Tribal General Welfare Exclusion Act. President Obama signed it on September 26, 2014. The legislation was a genuine win for tribal advocates, one that had been sought for years. The act codified at Section 139E of the Internal Revenue Code a formal tax exclusion for tribal programs, educational assistance, housing support, elder care, cultural preservation activities, language programs. All of these, when provided by a tribal government to its members as general welfare, are now formally excluded from taxable income. Tribal leaders celebrated. Money for health care and cultural preservation flowing tax-free to members, that was a real win. But buried in the text of Section 139E is a single sentence that rewrites the celebration. Read it carefully. The exclusion states Section 139E does not apply to, quote, per capita distributions of gaming revenue. Congress gave with one hand and withheld with the other. The General Welfare Act protects housing assistance. The General Welfare Act protects language camp funding. The General Welfare Act protects elder care payments. The General Welfare Act explicitly does not protect the largest check most gaming tribe members receive. The casino check, the most financially significant payment in the entire per capita distribution system, remains fully taxable under the 1967 ruling. Still, in 2025, Congress had the opportunity, in 2014, to extend the general welfare exclusion to gaming distributions. It chose not to. That choice is in the statutory text. It is deliberate. It is documented. Section 139E, Preserved Revenue, Ruling 67-284, as controlling authority for gaming per capita payments. The ruling, written before a single tribal casino existed, is now, after the General Welfare Exclusion Act, more entrenched than ever. Because Congress has now twice addressed tribal tax exclusions, IGRA, in 1988, the General Welfare Act, in 2014, and both times left gaming per capita distributions fully taxable under the 1967 framework. That is not an oversight. That is a policy choice, twice confirmed, written into the United States Code. The most revealing part of this story, what it means for the 574 federally recognized tribes, is still ahead. But first, the infrastructure the federal government built to administer this system deserves its own examination, because it is not informal. It is not an afterthought. It is a dedicated federal apparatus. In 2006, the IRS formally established an Indian Tribal Governments Division within its organizational structure. The division sits inside the Tax-Exempt and Government Entities Operating Division known as TEGE. The placement is itself a statement. Tribal governments are classified with other tax-exempt entities for IRS administrative purposes. The tribal government, like a university or a foundation, is a tax-exempt institution under IRS classification. But unlike a university, the tribal government has this additional function, distributing per capita payments to individual members. The Indian Tribal Governments Division monitors both the exempt status of tribal governmental enterprises and the compliance of individual tribal members in reporting per capita distributions as taxable income. 1 federal office. 2 functions. The same division that protects the casino's tax-exempt status also enforces the tax on the casino check. This is not a conflict of interest in legal terms. It is the logical consequence of the dual citizenship structure. But it is worth sitting with for a moment. The federal government maintains a dedicated office whose work includes, specifically, systematically monitoring whether individual Native people are paying taxes on their casino distributions. The IRS-TEGE Indian Tribal Governments Division is federal infrastructure built around taxing individual Native people's gaming income. That infrastructure did not exist before the casino industry existed. It was built because the casino industry made it necessary. Revenue Ruling 67-284 created the legal authority. The casino industry created the scale. The IRS built the office. Now consider what happens when a tribal member in California receives a large per capita distribution from gaming revenue. Federal income tax applies. Revenue Ruling 67-284, ordinary income, up to 37%. California state income tax also applies. The California Franchise Tax Board treats tribal per capita gaming payments as ordinary income. California's top marginal state rate is 13.3%. A tribal member in California receiving a large per capita distribution could face a combined marginal tax rate exceeding 50%. More than half of a per capita casino payment generated on sovereign tribal land, distributed by a sovereign tribal government, goes to federal and state governments before the member can spend $1 on anything. The land is sovereign. The casino is sovereign. The government operating it is sovereign. The check is not. The envelope crosses a line that sovereignty cannot follow. This brings us to the moral architecture of the question, the part that does not resolve cleanly. Tribal sovereignty as a legal concept is real, documented, treaty-based, and constitutionally recognized. The tribal government's exemption from federal corporate income tax is a genuine expression of that sovereignty. Federal courts have affirmed it. The IRS recognizes it. No serious legal challenge to it succeeds. But sovereignty, as most people understand it, as most voters and legislators use the word in debate, implies something broader than what the law actually delivers. The public understanding of tribal sovereignty often includes untaxed individuals, untaxed income, an economic enclave outside federal reach. That understanding is not what the law says. It is not what Revenue Ruling 67-284 says. And the gap between public understanding and legal reality is where policy mistakes are manufactured. When a legislator argues that tribal gaming operates in a tax-free zone, they are describing the institution, not the people. When a voter opposes tribal gaming compacts on the theory that Native people pay no taxes, they are wrong in a specific, documentable way. The National Congress of American Indians has addressed this directly in testimony before the Senate Committee on Indian Affairs. In hearings on the Tribal General Welfare Exclusion Act in 2013 and 2014, tribal advocates made the distinction explicit. The position consistently articulated, quote, "Sovereignty doesn't mean we don't pay taxes. It means our government doesn't pay taxes. Our people as individuals are still American citizens, subject to American law. The people who live inside tribal sovereignty, the enrolled members receiving per capita checks, are making this argument themselves. They are not arguing for exemption from individual taxation. They are arguing for clarity about what the law actually says. Because the myth of blanket native tax exemption hurts them in ways that are specific and measurable. It shapes how Congress writes legislation. It shapes how courts evaluate tribal economic claims. It shapes federal funding formulas. If Congress believes tribal members already have untaxed economic advantages, federal support programs get cut accordingly. The myth is not neutral. The myth has policy consequences. And the myth is demonstrably wrong. Revenue Ruling 67-284 proves it. Now, a number that belongs in every conversation about tribal gaming economics and almost never appears there. Pine Ridge Reservation in South Dakota is home to the Oglala Lakota Nation. The poverty rate at Pine Ridge is approximately 53%, among the highest in the United States. There is no major tribal casino at Pine Ridge generating per capita distributions. The Oglala Lakota Nation does not have a Mystic Lake, does not have a Harris Cherokee. The economic geography of tribal gaming is radically uneven, and that unevenness is the other half of this story. Of 574 federally recognized tribes, approximately 329 operate gaming enterprises. That means roughly 245 federally recognized tribes have no gaming revenue at all, no per capita distributions, no casino income, no Form 1099 MISC from a tribal gaming operation. For those tribes, Revenue Ruling 67-284 is largely theoretical. The machinery exists, but there is nothing to run through it. The tribal gaming industry generated over $40 billion in gross gaming revenue in 2022. But that number is concentrated. The top 20 highest grossing operations generate a disproportionate share of total industry revenue. Pine Ridge and Mystic Lake are both, technically, part of the same policy category. Tribal nations in the United States. They exist 1,400 miles apart in the same country with economic realities that share almost no common ground. One tribe's enrolled members receive potentially seven-figure annual distributions, taxed by the IRS under a 1967 ruling. The other tribe's enrolled members face a 53% poverty rate, with no casino check arriving at all. Both outcomes are described by the same phrase, tribal sovereignty, the same legal framework, radically different material results. The legal architecture of Revenue Ruling 67-284 treats these two situations identically, which is to say, when distributions exist, they are taxed. When they do not exist, the ruling is irrelevant. The ruling is indifferent to this disparity. Tax law generally is. But policy should not be, and voters and legislators who understand this disparity make better decisions than those who do not. This is where the story's internal tension becomes genuinely difficult to resolve with any simple conclusion. The IRS taxation of per capita gaming distributions is legally consistent. The law is coherent on its own terms. The dual citizenship framework, tribal citizen and United States citizen, produces the result. Revenue Ruling 67-284 applies. Individual American citizens pay federal income tax on income received personally. Tribal members receiving per capita payments are individual American citizens. The logic is airtight within the framework that Congress and the courts have constructed over a century. And yet the intuition that something is asymmetric here is also not wrong. The casino on sovereign land, using sovereign governmental immunity, generates revenue free of federal corporate tax. The individual member who receives a share of that revenue then pays federal tax at ordinary income rates. The sovereignty benefit accrues to the institution. The tax burden accrues to the person. Whether that asymmetry is just depends entirely on what you believe sovereignty is for. If sovereignty is for tribal governments, as political entities protecting their institutional capacity to self-govern, then the current framework is consistent with that purpose. If sovereignty is for tribal people, as human beings protecting their economic well-being and cultural continuity, then the gap between what the casino doesn't pay and what the member does pay is harder to justify. Neither answer is obviously wrong. Both answers have consequences. The 2014 Tribal General Welfare Exclusion Act shows Congress understood this tension and navigated it partially. Congress drew a line: cultural and welfare programs tax-free, casino distributions taxable. That line reflects a judgment about what sovereignty should protect. Congress made the judgment explicit by carving out gaming distributions. The carve-out in Section 139E is not accidental text. Someone in Congress put it there. Someone left it there. The most significant individual payments in the tribal gaming economy remain subject to the oldest applicable tax ruling in the record, 1967, before a single casino chip, before Mystic Lake, before Harrah's Cherokee, before IGRA. The ruling arrived before the industry. The industry grew to fit the ruling. The ruling has never moved. Now consider what 2024 and 2025 bring to this conversation. The Tax Cuts and Jobs Act, passed in 2017, contains provisions scheduled to sunset after 2025. Congressional debates around that sunset have reopened broad questions about the federal tax code structure. Some legislators in these debates have conflated tribal governmental tax exemption with individual tribal member exemption. That conflation, the exact myth Revenue Ruling 67-284 disproves, is appearing in legislative arguments again. When a legislator argues that tribal entities receive unfair tax advantages in the context of broader tax reform, they may be describing the casino's corporate tax status, which is real and documented. Or they may be describing something that does not exist, a blanket exemption for tribal individuals from income taxation. Those two arguments require completely different policy responses. Conflating them produces bad legislation. The IRS publication 4268, Indian Tribal Governments, is a public document available at irs.gov right now. It states clearly that tribal members receiving per capita distributions must include those distributions in gross income. It says this plainly. It cites Revenue Ruling 67-284 as controlling authority. This is not obscure. It is not classified. It is sitting on the IRS website, available to any legislator's staff in 60 seconds. The public misunderstanding persists not because the information is hidden. It persists because the nuance is never explained. The nuance: tribal governmental sovereignty and individual tribal member tax status are entirely separate legal questions. Conflating them is as wrong as arguing that because a nonprofit hospital pays no corporate tax, its nurses pay no income tax. The nurses pay income tax. The tribal members pay income tax. Revenue Ruling 67-284 has said so since 1967. Let us close by returning to the document itself, the ruling, and the specific legal language that has governed this system for nearly 60 years. The ruling cites Section 61 of the Internal Revenue Code: all income from whatever source derived, That phrase, whatever source derived, was written by Congress. Revenue Ruling 67-284 applied it to tribal distributions. Congress could amend Section 61. Congress could add an exception for per capita gaming distributions. Congress has had that option since 1988, when IGRA created the industry. Congress has not taken it. Congress had that option again in 2014, when the General Welfare Exclusion Act passed. Congress did not take it then either. Section 61, all income from whatever source derived, still the operative text, still applied to every per capita gaming check. The machinery is in place. The IRS Indian Tribal Governments Division monitors compliance. Tribes issue Form 1099 MISC documents. Members file Form 1040. The same Form 1040 used by every other American worker. The same federal rates. The same April deadline. Sovereignty ends at the mailbox. Revenue Ruling 67-284 drew that line in 1967. No court has moved it. No Congress has removed it. No IGRA provision displaced it. No General Welfare Act touched it. The ruling that predated the industry by 21 years has outlasted every legal challenge to its application. And most public debates about tribal gaming, most news articles, most congressional testimony, discuss the $40 billion gross revenue figure without mentioning the specific mechanism taxing the distributions that flow from it. The mechanism has a name, it has a citation, it has a year. Revenue Ruling 67-284, 1967-2 C.B. 55. 11 paragraphs, published without fanfare, applicable to billions of dollars in individual Native people's income every year. If you are a policy analyst, a legislative staffer, a tribal governance scholar, or simply someone who wants to argue about sovereignty accurately, you need to know this ruling exists. You need to know what it says. You need to know what it has never covered. The tribal casino is sovereign. The tribal government is sovereign. The enrolled member filing a 1040 is not. That is the legal reality. That is what the document says. That is what the IRS has enforced, consistently, for nearly 60 years. Whether it should still say that in 2025, with the Tax Cuts and Jobs Act sunset approaching, is a question that belongs in every serious conversation about tribal economics, federal tax reform, and the practical limits of sovereignty. The conversation cannot be serious until it starts with the right document. 1967, page 55, 11 paragraphs. The line sovereignty has never crossed, and Congress has never moved. If this breakdown changed how you think about tribal sovereignty and tax law, share it with someone who needs the precision. The policy debates happening right now in Congress will be better or worse depending on whether this specific distinction is understood. One ruling, 60 years old, 0 tribal casinos when it was written, waiting, still for every check. If this breakdown changed how you think about tribal sovereignty and tax law, share it with someone who needs the precision. The policy debates happening right now in Congress will be better or worse depending on whether this specific distinction is understood. One ruling, 60 years old, 0 tribal casinos when it was written, waiting, still, for every check.